Hey everyone, so I could do a really quick update and just tell you that my portfolio grew just over £4,100 in the past month, so December 2023, from £144,745 to £148,872, a return of just under 3% for the month, which is good, don't get me wrong. If that's all you've tuned in for, then thanks for tuning in, it's been a pleasure. But if you want an overview into how my portfolio has performed over the full year 2023, and also since I actually started investing, then please do stick around. If we take the year in total, it's not been bad in isolation. I began the year of 2023 with £70,338 invested. I then invested a further £10,764 of my hard-earned, just my money, and ended the year with £148,872 that I've just mentioned. That is an 83.6% money-weighted one-year return. To put that in perspective, the standard benchmark that everybody uses, the S&P 500, returned just under 25% in 2023. Now, I also wanted to zoom out a little bit further and look at how my portfolio fared since I started investing properly back in 2019 and 2020. So my weighted average return is only a compound annual growth rate of 5.8%, which when I first kind of saw that number, I was a little bit downhearted and disappointed, and it doesn't sound great. Well, I then took the time out to compare what would have happened if I bought the S&P 500 index instead of buying Tesla, MasterCard and Google at the times when I did over the past few years. I would have only achieved 4.6% compound annual growth rate, which made me feel better about the investing decisions that I've made. Now, 1.2% CAGR, so every year, might not seem like a lot, but over the 5 or 10 or more year period, that additional gain above the market really does add up. And to put that in perspective, if you started with £100,000 and achieved 4.6% over a 10-year period, you would end up with just over £157,000. But if you achieved 5.8% like I did, with that same £100,000 over the same time period, the 10 years, you would have ended up with £172,500, which is a further or additional 15% gain for no extra money put in. Now, switching up a little bit, in my last video, I said that I was going to give you a short list of the companies that I am personally looking at investing in or are within my investing universe. So let's cover those off briefly now. And if you'd like to know any more details on any of them, then do drop me a comment below. First up, and very high on my list of companies that I potentially invest in, is Costco. People probably didn't expect that to be the answer, but they are a steady and stable growth company. Yes, they're low margin, but they have huge membership income that's growing. They outperform the S&P 500 each and every year generally. They pay a dividend, and they're a company that's fair to both customers and employees. Well, not both, but all, because I would like to include shareholders in that. What more could you really ask for? And why haven't I invested in Costco yet? I just think that they're slightly overpriced, really. That's it. Next up, Microsoft. I owned Microsoft back when I started out investing small amounts in 2019, 2020, before I decided to make the move and go all in on Tesla. They have great business segments that they operate in, have great management, they pay a growing dividend each and every year, and they buy back shares. They also acquire good companies to help the growth. So they're an all-round powerhouse of a company. Next up, Visa. If I didn't own MasterCard, I would definitely own Visa. I like the payment market space. They are the market leader, they have high profit margins, and it's a toll booth market or business model. They take a small fraction of the transaction cost when you buy products or deal with your debit or credit card. Like MasterCard, I don't see these businesses struggling over the next couple of decades, even with the disruption of PayPal and other Finco companies. They are expanding into the untapped markets like Africa, which I think has got huge room for growth over the next 5-10 years. Now, for the next companies, there are two that some of you probably won't have heard of at all. First up is FICO, or Fair Isaac Corporation. They are a credit risk company that offer data analytics and credit scoring services. FICO, they just grow. They print money. They're not a massive company. They don't have masses of income. They have about 1.5 billion of revenue. But their gross margin has grown consistently from it being just under 70% back in 2018 to now just shy of 80% in 2023. That shows that they have both pricing power and a service that is needed. That large gross margin has filtered down into both a growing profit margin and free cash flow margins, as well as consistently growing EBIT. The company is very capital light, doesn't have to spend that much on capex. It's basically a data consulting software company. So what it does is it returns a lot of that capital that it produces, the EBIT, back to shareholders in the form of buybacks, share buybacks. I prefer share buybacks over dividends, as at the moment it's literally a 1% tax that they have to pay, whereas if it's dividends you've got to pay the 15% withholding fee. My only concern with FICO would be that they spend quite a bit on share-based compensation, and that's around 30% of their net income that the company generates. But that has been on a downward trajectory over the recent years, and management are getting that under control. The main reason why I don't own them at the moment is, like Costco, I think they're slightly expensive and they're trading at a high PE. But at the end of the day, these are businesses that do always command a premium when you own them. Final company, probably an unknown company to many, is another small company called Celsius. Celsius are small and have only come into my radar over the past few months after they've posted both impressive growth numbers recently, the past 3 or 4 years, as well as their expansion plans that we've seen. So in the news, they've mentioned that they've partnered with PepsiCo. They are the distribution network that they're using for their drinks products. If you look at the share price, well, from the COVID lows of around $1.50 that the company was valued at, they've grown by 3,800% since then to be trading at $57 a share today. They have a very, very small market share compared to the likes of Monster and Red Bull, the two main rivals. They don't focus on advertising in the sports arena and domain like the other two do. They're very much more broad, and the packaging isn't as specific or harsh. It appeals to a more general audience, or that's my view anyway. Whereas the likes of your Red Bull and Monster are sports drinks or energy drinks in that area. Over the next couple of months, I will be revisiting both FICO and Celsius, the two that I've just previously mentioned, and I'm going to be doing a deep dive for my benefit to determine if I should diversify even further and open up a position in one of these two as my 5th holding. Anyway, I hope this update has been interesting. If it has, please do drop this video a like so others get to see it, and also subscribe to the channel if you haven't already. But until next time, stay safe.